I have a portfolio of properties all over southwestern Ontario. So I have Hamilton, Newmarket, Toronto. I have properties in Alberta, Arizona. And the best performing properties in my portfolio have always been in the GTA, for sure, by far.
Thank you for everyone for joining us for another Wednesday real estate investment webinar. And my name is Ashton Ekbatani. I'm doing real estate investment for over 16 years. Typically, I'm going to introduce you to the goal or reason why we have this webinar is to help you to move from where you are. It doesn't matter if you're newbie or real estate savvy or or speculators. Our goal here is to move you from where you are to make you more keen and expert in real estate investment. So this is where many of investors are. They are blowing to the right or left because of the news or media they hear. And the goal is supposed to be having a clear roadmap and go from there. Usually and typically in every gathering we have on webinar, we are covering the housing market in Toronto, and they bring up all the stats and information, and that would help us to make sure we are working on the right path. But today, because of the timing that Darren has, so we have to move him up to the very first portion of this webinar. So the topic here is make big money with fix and fix and flip single homes to multiplexes, and this is how I do it. And thank you, Darren, for joining us on this episode or this session of real estate investment. Darren, he's a real estate investor for many, many years. How many years you are in investment, Darren?
18 years now.
18 years. Okay, great. Darren is an accomplished real estate investor, trainer, and coach. He controls a portfolio of properties worth just over 10 million, and he travels across North America, educating, inspiring, and motivating audiences on the subject of real estate investing, financial independence, and financial literacy. And without further ado, Darren, this is the time for you to go on.
Excellent. Well, first of all, thank you, Ashton, for having me on. I really appreciate being able to speak to your audience and hopefully impart some knowledge. I will happily take questions in whatever format you'd like to do that tonight, but I prepared a little bit of a presentation just on this latest acquisition that we're doing right now. It is essentially an apartment apartment conversion. So we're taking a single family dwelling and we're converting it to we could like to call it a boutique apartment building. 8 units is going to be the number that's in this apartment building. So if you don't mind, I'll share my screen and kind of jump into my presentation here.
Yeah, absolutely. Just give me a second. Okay, I think you can take over.
Excellent. So, yeah, let me see here. Okay. Hopefully we're getting better at this Zoom stuff. We've been doing it now for a little while. So, all right. Can you see my screen?
Yeah, absolutely. Perfect.
Okay, excellent. So this is the property that we're going to be talking about tonight. This is a property located in High Park. So I know you said that a lot of your audience is Toronto based, so you would definitely know High Park. This is actually halfway between Keele Station and High Park Station, about a 3-minute walk in either direction, just north of Bloor, right by the park. And this is an old, as you can see, this is an old Victorian home, probably built in the early 1900s or late 1800s. A beautiful brick home. That's been well maintained. The structure of the property is very good. We saw this property in the summertime. I think it was June or July. And, we walked through it. And to be honest with you, I wasn't really thinking that this is going to be a feasible investment for me just because the purchase price. The purchase price was higher than anything else I'd ever purchased before. And I wasn't sure that it was going to make sense. But when I started to look at the lot and, the surrounding area and what the possibilities were because of this large house and this large footprint, then I realized there actually might be some possibilities here. And so I'll kind of walk you through the process on how we purchased the property, how the conversations have gone around the zoning and the city and everything that's happening there. And then ultimately what the plan is, and I'll walk through the numbers at the end just on this transaction and how it's going to work for both us as the working partners and the investors in this transaction as well.
Mhm.
So first and foremost, I wanted to sort of talk about how we acquired this property. This property was an unlisted property. It was an exclusive listing that a realtor brought to me. And so this is the value, I think, of creating relationships with realtors that know exactly what you do. This realtor knew that I've done apartment conversion. I've done smaller projects than this before. I've done a lot of triplex, fourplex conversion, some laneway housing, some duplex conversion. But the value of that realtor knowing what I've done in the past brought this transaction to me. So it wasn't on the open market. It was brought to us exclusively, which gives us a little bit more flexibility on the actual acquisition of the property. So we made an offer, and this is something that I've not really been a part of before on a residential transaction in Toronto. We put a 30-day conditional period on this property. And the reason why we were able to do that is we weren't really competing with anybody else, and we wanted some time to do our due diligence. So during our 30-day conditional period, we wanted to secure some financing. So we wanted to make sure that we could actually make this a viable project, that banks would finance it. We wanted to secure our investor group. So we were looking at the capital that we were going to need for this property, and we were looking at the investor group that wanted to be able to do that. So we wanted to be able to pull that together, at least in principle, prior to removing conditions. And of course, we wanted to do a home inspection. Also, along with that, we wanted to bring our architects, our designers through the building, our contractors, to make sure that what we wanted to do on this property was feasible. Once we had done that due diligence, we had asked for a price adjustment, and we wanted to extend the closing. So we locked up the property. We did our 30 days of due diligence. And at the end of those 30 days, we only had about another 30 days to close on the property. We wanted more time. And so we asked for an extension, and we asked for a price adjustment as well. And we were able to get both of those things. So we pushed out the closing till the end of October, which is coming up next Friday, which gave us about 3 months of lead time to be able to start working on permit applications and start working on various elements of this deal. And then we also got a price adjustment. So just to give you some numbers to start off, we had this property under contract at $2.8 million. And we were able to get the price adjusted down to 2.75 after the home inspection turned up some asbestos in the property, some issues with mold in the basement. None of these were really big deals to us because we know that we're going to essentially gut the entire interior and start all over again, but we still want to use that as a negotiating tool in the transaction. So I guess I'll kind of pause there. And if there's any questions you have, Ashton, or anybody else, I guess I can pause there before we move on.
No, go ahead. So far, so good.
All right. So the big question that comes up on something like this is, how do you know if you can convert a property to an apartment building? And, this all comes down to zoning. And some people might be familiar with Toronto zoning. Some people maybe have never really looked at the zoning too much. But I wanted to just kind of show you something really quickly. Pretty simple here. I want to share with you what we do when we're looking at zoning. So I'm going to stop sharing this and I'm going to share something else. Just going to go into the city of Toronto has a great resource for us as investors that we can actually find the zoning on properties. So can you see my screen there?
Yeah.
Okay.
Yeah.
So I'm going to enter the property address. And you can just do a Google search for, interactive zoning map. So I enter the address, it comes up, I click on that, and then I can essentially go in, zoom into this property and realize that this property is essentially in what's classed as an R zone. The density is listed there as well. So this is R zone, density is 0.6. And what that means is you take the lot size and you multiply that by 0.6, and that will tell you what the developable square footage on that lot is. So the beauty of this lot, and this is why we were so interested in this property was a 42 by 200 lot. And I'll zoom in a little bit here so you can see it.
Wow.
You'll see that that's a large lot for the city of Toronto. I'm not sure if you can see the property lines, but this
Yes.
is our lot and it goes all the way back here. You'll see the other lots end right here, and then these properties actually come back and end here, but this lot goes all the way back. So with a 42 by 200 lot, that means that that's 8,300 square feet is the lot size, and we can develop 0.6 of that lot without having to trigger a variance. So if you take your 8,300, you multiply that by 0.6, and that tells me that we can develop 5,000 square feet in that property above grade before we trigger a variance. And so this was a really important thing for us to be able to find out early on in the process. And then if I look at the zoning here, can you still see the screen there with the
Yes.
zoning? Yeah.
Yep.
So if I go to the zoning bylaw, and if you're looking for some very uninteresting reading, you can look up the zoning bylaws. But what this tells me is if I go down to the R zoning, the permitted uses of the building types in this zone are detached house, semi-detached townhouse, duplex, triplex, fourplex, and an apartment building. So this building, now I know that I can develop 5,000 square feet of this building, and I know that I can put an apartment building on this property. So this is really the due diligence that you want to do before you even start making offers on properties, to know what the possibilities are to be able to do with a property like this. So I just kind of wanted to show you that for those people that have never really looked up the zoning on a property and what's available. And you'll also see here, we could really spend a lot of time on this, but I won't spend much time. You can see the discretionary uses, the permitted uses with conditions, things like laneway suites, rooming houses, secondary suites, short-term rentals. So you really want to know your zoning bylaws and your zone to know what you can build on this property. So that was the initial due diligence that we did essentially on this transaction. And I'll kind of go back to my presentation here now. But that's how we figured out what we could do with this building. Now, how do you get an approval for an 8-unit building when you've got a single family dwelling? Well, there's many steps in this process. And the nice thing about, like I said earlier, when we closed on this property with 90 days of runway, we can start that process as long as we write that into the real estate agreement. So this is something that I would suggest that if anybody's interested in doing this kind of project or any kind of renovation project that requires a permit or a zoning change or anything, write it into your real estate agreement so that the sellers will agree. Essentially, the wording is that you can apply for permits on behalf of the sellers and they agree to cooperate at your expense. So I'm not asking the sellers to pay for those permit applications or anything like that. All I'm saying is that we want to apply for permits while we're waiting at our expense, but you're going to sign off on those permit applications. And that saves us a lot of time that we can be applying for permits and getting this process started while we don't even actually own that property yet. And if you think about it, there's really no risk to the sellers. If for some reason this transaction didn't close, we haven't done anything to the property. We've just submitted applications at our own cost. And if we didn't go through with the property, the sellers would just cancel those applications and there'd be no any sort of implications to them for that property moving forward in the future. So usually an amenable thing that the sellers are willing to do. So the first thing you have to do is actually create architectural drawings. So this would be something where my architects are going to go in, they're going to see what's the existing building and what do we want to build. So we created, if I had more time, I'd actually walk you through the floor plans or everything, but we created 8 units in this building. So each floor is going to have essentially 2 apartments on it. So we're going to do the basement, the main floor, the second floor, and the third floor. So we're doing an addition off the back and we're going to go 3 stories up. So there'll be about 1,500 square feet per floor in this building. So 2 bedroom, 1 bathroom apartments and 2 on each floor. So that's what we do. We create those architectural drawings. Once the architectural drawings are created, now we're going to go and submit them for what's called a zoning review. So we'll submit them to the City of Toronto. and we will see what the zoning comes back and looks at them from all the bylaw perspective. Now, in my experience, I have never submitted plans to the City of Toronto without triggering some sort of minor variance on an apartment conversion like this. So this almost always means that we have to go through the Committee of Adjustments process, which means that the property is zoned for what we want to do, but there might be a minor variance that it doesn't meet the zoning bylaw. For instance, on this property here, the parking was an issue. So we have parking, we have 3-car parking, but because we're doing 8 units, we are required to have 7 parking spots. So that's a minor variance. So we have to go and submit an application to the Committee of Adjustments. This process can take anywhere from 4 to 6 months to get a Committee of Adjustments hearing. And essentially you're working with the city planners and everybody to try to get your application moved along. You're also working with your neighbors, letting them know what's happening, getting everybody on board. Sometimes you can get letters of approval from your neighbors saying they support the application. More often than not, you'll get a little bit of pushback from your neighbors, depending on what you want to do. But I always suggest to people to have conversations with their neighbors and make sure they're telling them what they're doing and trying to get them to buy into the project. And if there's something that they're not happy about, try to work that out prior to getting to Committee of Adjustments.
So one question there for you. In terms of the timing here, 4 to 6 months approximately, I know it all depends to how big is the adjustment. Are you renting the property meanwhile you're getting the permit, or you just keep it vacant?
Yeah, that's a great question. I've done both. This property we're acquiring is vacant, so I'm not going to put tenants in there to then have to remove them. But other properties that I've had have been tenanted properties. And so I keep the tenants in there as long as I can, because while I'm applying for the permits and going through this process, I've got revenue coming in to support the loans and things like that. Now, in this case, because we've got that 3 months of long closing, I actually submitted the applications for the committee months ago. So we're in the queue to get our committee meeting. So it's probably only going to be 2 to 3 months after we close, but we've had to submit those applications prior to actually taking possession of the building. Now, this is 4 to 6 months is also very long right now because of COVID. It's usually a 3-month process. 3 to 4 months, I would say, is the standard for Committee of Adjustments. But because of the current situation and the backlog of applications, that's why it's 4 to 6 months. So after your Committee of Adjustments application is submitted, you'll eventually get a Committee of Adjustments hearing. This is where your architect, your designer, your engineers, whoever you're going to have represent you stands in front of the committee and basically talks about your application. It's a panel of 3 or 4 people, and they basically look at your application. And if your variances seem minor to them, then they approve it. If there's no neighbors that have any issues, there's no planning or city departments that have any issues, essentially you get your approval for your building and away you go. After Committee of Adjustments, there's an appeal period. So somebody could appeal the decision if they didn't get what they wanted at the committee. That has to be a 30-day period. If there's no appeals filed, you can then apply for your building permits. And once your building permits, that process can take anywhere from 2 to 12 weeks, depending on how many adjustments need to be made from the building department. And then after that, your building permits are issued and you can begin work. So the thing that we like to do is actually work in stages. We like to find a way that we can begin construction, whether that's, we can get a simple underpinning permit if we're going to be underpinning the basement, or we can get a demolition permit to start removing all the interior finishes. We don't like to be dormant for too long. So even if we're taking possession of the building, we like to be moving things along from some sort of construction perspective, as long as we can do that legally with the buildings and the building department. So that's the process for getting a building permit for an apartment building.
Excellent. Very quick question, just to give a perspective to our audience here. Now you purchased it for 2.75 and you are planning to put 8 units there. What is the price that you have in mind for each unit?
For the renovation or for the
purchase or selling price?
So this is not going to be a building we're going to sell. This is going to be a building we're going to hold as a rental.
Okay.
Yeah.
Okay.
So we're targeting basically an after repair value of around $5 million. So the building, when you get into commercial buildings like this, commercial buildings are not valued on comparables like a residential property is. Commercial properties are valued on net operating income. So what the property brings in every single year or every single month. So if we run, and we had to do this, we had to have an appraisal done, an as is appraisal and a feasibility appraisal, which says when the building is done, what's the value of the rent's going to be and what's the value of the building going to be. And so we had those done prior to even removing our conditions. And it said the value of the building was what we paid for it. And when we were done, based on the scope of work, it was going to be worth just north of $5 million. So we kind of know that going in based on the appraisal. And the reno budget for this project is around $1.5 million.
Okay. Any challenges in regard of, I know it's commercial, so the mortgage is in different ball game here. Any challenges for the mortgage?
Yeah, I think it might be my next slide here. Yeah, it's financing. Because this is a unique property. If you think about this, we're buying a residential property. And so we're converting it to a commercial property. So it's a little bit tricky with lenders sometimes when you're looking at this. So because of this, I sent the file to various brokers. Now I want to caution you on doing this because you don't want to send it to various brokers that are going to be submitting to the same lending institutions. The reason I send it to various brokers is because I have a broker that works with me on most of my residential files. And then I have somebody who works with me on most of my commercial files. And then I have somebody who works with me on my private lending files. And so I would send it to those three people, but I don't want to send it to multiple residential brokers, multiple commercial brokers, because if a lender sees an application coming in from a couple different brokers, they don't generally like that. But because the property is residential, ideally we're securing residential financing on that property because it's the least expensive financing that you can get. But sometimes it doesn't work depending on how the lenders view the file. So we have to look at all three options. So we got some initial feedback when we submitted to our different brokers. And we really looked at all three options. What did it look like if it was private? What is it residential? And what is it commercial? And because this building was a 7-unit illegal conversion at some point, somebody went in and divided it up and put these little kitchenette units in there. We were having a hard time getting residential financing. And so we had to go on the commercial side. Now the commercial lenders were willing to do a bit of a hybrid loan. They were saying, okay, well, we'll give you a loan to purchase the property and we'll actually also finance a portion of the renovation. And so we were able to secure a commercial lending loan, but it's at a higher rate than I would get with a standard commercial or residential, but it's at a lower rate than a private loan. So we were able to get a 2% lender fee on the entire amount of the first purchase mortgage and the renovation money. And then we were basically going to be paying an interest rate of around 4.5% to 5% on that money. So that's what we were able to secure on this property.
Excellent.
We had to set up a new corporation for this purchase because I like to hold properties in corporations whenever I can, and because we have a bunch of shareholders coming in, investors coming in on this property, we also wanted to make sure that we have a corporate structure. Just gives us a few more options, and so we had to go into a lawyer and set up a new corporation. Just to let people know, I often like to set up new corporations every time a property sort of exceeds that $2 million threshold. So if I have multiple properties that are, let's say, $500,000 each, I might put 4 properties under one corporation. But the moment that threshold goes above 2 million, I like to set up a new corporation. So when we're purchasing a property like this that's already over $2 million in purchase price, we would just set up a new corporation to hold this property solely. And so that's what we did. We draft the shareholders agreement. That has to be done financing in the financing phase. The lawyers drop the shareholders agreement for ourselves and all of our investors. And I just wanted to caution everyone on some of the hidden costs if you've never done a commercial transaction, because they are a little bit different than a residential transaction. Residential transaction, we generally have a home inspection, an appraisal, and some legal fees. On a commercial transaction, you can be looking at very different costs when it comes to what the lenders want to see. So we were required to do what's called an ESA inspection. This is an environmental inspection to make sure that the property doesn't have any environmental issues. The cost of this inspection is around $3,000. A commercial appraisal, as I mentioned earlier, residential appraisal is going to run you anywhere from, I don't know, $300 to $800, depending on the size of the building. A commercial appraisal, the one that we had done, was $3,500 because they're doing the as-is appraisal and they're doing the feasibility appraisal as well at the same time. They're also going to look at all the market rents in the area, and they're going to run the cost analysis on the property as well. So that's an additional cost. Legal fees, very different on a commercial transaction than they are on a residential transaction. We also have to pay legal fees for the joint venture agreement or the shareholders agreement that we drop. So our legal fees are going to be somewhere in the range of $12,000 to $15,000 on this transaction versus a standard legal fee of, maybe $1,500 to $2,000. And then some lenders will have very strict insurance requirements, especially if they know that you're going to be doing construction on a property. They want to make sure that you've got a builder's risk policy, and these can cost, more than your standard policy. So some of those are the hidden costs that I just wanted to make sure everybody is aware of when you're looking at something along this nature. And I want to just kind of walk you through the numbers, show you, I'm gonna close out of here and show you the numbers on this project. So I use a software, as I'm sure many of you do. I use a software called Deal Check. I find it's very robust, and I really like the way that it does reporting. But I'll just kind of walk you through the numbers on the project. So as I mentioned earlier, we're purchasing for $2.75 million. Our after repair value, and this was set by the appraiser, is around $5.02 million. The property needs about $1 million in cash to do this transaction. We're going to generate about $2,500 a month in rent. And this gives us a 7.2 cap rate on the purchase. This one's a little bit off because it accounts for the purchase price at 2.75, but it accounts for the values of the rents when the building is done. So that's not an accurate number, but it is there. You'll see the actual cap rate later on. So this is a bad picture of the property there. So here's our units and our rent roll. So we're targeting, as I mentioned, 2 units per floor. And these are going to be 700 square foot units, 2 bedrooms. That should say 1 bathroom there. But the basement units, we are looking to get about $2,400 per unit. The main floor, second floor, and third floor units should be generating about $2,600 per unit. And this would be inclusive of utilities except hydro. So the way we're setting up the building is one central heating system. It's the most efficient system that we can put in a building like this. It'll be a central boiler with radiant in-floor heat. And therefore we will pay the bill as the owners on the gas. And then that boiler would also do the domestic hot water. I have a very similar building that operates on this system, and it's not that much to heat in the winter and run the domestic hot water. It runs about $225 a month for the gas bill for the entire building. So it's much more efficient this way than putting in separate heating systems for every single unit. There's a huge cost to that. So these prices would be plus hydro and plus internet cable, all that other kind of stuff. And then we also have an additional revenue source, which is parking. So we will have 6 or 7 parking spots. Those will be rented out at $200 a month for whoever wants to have a car. And if we don't rent those to people in our building, we can rent them to people in the neighborhood as well. So that's an additional revenue source for us. So this is the neighborhood. You'll see it here. So here's the breakdown. This is the purchase price, as I mentioned, $2.75 million. The rental costs are around $1.5 million. So we're gonna finance. The financing works out to be 70% of the purchase price and 100% of the renovation. Now, the lender is not going to give us 100% of the funds for the renovation up front. They're going to do that in what's called a construction draw.
Yeah.
So once we get to a certain point in the renovation, let's call it, the permits have been issued, then they're going to give us a draw at that point because we're going to be, further along in the process. Then once we get the framing done and the building is closed in, that's another draw. And so the lender is always going to keep that 70% loan to value on the project, and they're going to advance funds throughout the renovation. But at least these funds don't have to come from us out of pocket. They come from the lender as we continue to grow the transaction. So our down payment is $825,000. Our purchase costs are $227,000. So I've got the purchase costs right here. You can see the home inspection, as I mentioned, the appraisal, the lender fee. So we're going to pay that 2% on the total $3.4 million that we're going to borrow. The environmental inspection is going to run us about $3,500. The legal fees, about $10,000. And the great land transfer taxes that we get to pay in the city of Toronto. We get the double land transfer tax. And then this is an acquisition fee. And you may not be familiar with this if you've never done a commercial transaction, but it's very common. Acquisition fee is for the working partners. So for myself and my partner, Alona, this is a fee that we collect, and this fee can be anywhere between 0.5% or 2% of the purchase price. So we did a 1% acquisition fee, and this is paid to us on closing for getting the transaction to this point. Mm-hmm. So you'll see some of the numbers here, the assumptions over here on the right-hand side. But I wanted to just go through the holding costs. This renovation is going to take about 12 months from beginning to end. So this is the loan payments that we're going to have to make during those 12 months, the property taxes, the insurance, the utilities. So our total carrying costs for the renovation are going to be about $197,000. So when we bring this down, these are all the rehab costs. So you can see, I wanted to just highlight two things here. Designers, architects, and engineers. We have what's called soft costs and hard costs on renovation. Mm-hmm. These top two are considered soft costs. Development charges. When you're taking a building from essentially 1 unit to 8 units, you have to pay development charges on those 7 units that you're creating. So for the city of Toronto, those fees are high. That's going to be about $400,000 just in development charges for the city. So you can see here, we're almost $450,000 into the transaction before we even really get started. And then you'll see the different line items that I've broken out here. One more thing that I wanted to just mention is the cost overrun. I like to build in a 15% buffer because definitely things will happen. Things will get extended or materials will cost more. Like if you look at COVID right now and what's happening, like a 2x4, 6 months ago was $3.50. It's now $7. So we want to make sure we're having some cost overrun in there. And our total cost per square foot on the renovation is going to run us about $263 a square foot.
And this project, how was the basement? Do you have to do underpinning? Because I know that neighborhood. Yes,
we are underpinning and we're doing an extension. So the walkout and the underpinning and the extension is built into this number here. Yeah, around 80,000. Mm-hmm. Yeah. So if we go down now to the refinance, so this will be after the renovation is complete. So 12 months later, now we're going to go to commercial financing, and you can see here the commercial financing rates. So now we're getting into amortizing this loan. So the new loan, because the new loan is based on 75% of the $5 million, that loan amount is going to be $3.765 million. We're going to be targeting a CMHC commercial loan, and CMHC you can amortize for 25, 30 years, or you can actually amortize for 40 years as well. So we've been getting feedback that we'll be able to amortize probably for 30 years, and our interest rate will be somewhere around 2% once this property is up and running and is a stabilized asset. So we get the new loan for $3.765 million. The refinance costs are going to be about $50,000. So there's going to be CMHC fees. There's going to be another lender fee. It's a smaller one this time on the commercial side, but there's all the legal fees as well for the refinance. We're going to pay back the original loan. So that's the first mortgage and the renovation costs. And then we're going to hold that was the holding cost that we had to pay out through the 12 months. So after the refinance, we're only going to get $115,000 back in our pocket. But we had $1 million invested to begin. We're going to get $115,000 back, and we're going to have a total cash invested in the project at this point of $936,000. And we're going to hold the property now as a long-term rental. So essentially, we've got the same amount of cash invested. After a year, we've stabilized the asset, and now it's going to be a long-term rental property. So you can see the cap rate then becomes 3.9%, which is a pretty standard cap rate. The return on investment is about 35% in the first year. That's just year one. And then I'll show you the analysis on the cash flow. So this is the gross rent, about $20,000 a month. We always build in vacancy, even though the vacancy is a little bit less than this in Toronto right now. We like to build in at least 3% vacancy. The other income is the $1,200 in parking revenue. And then our operating expenses are broken out here. So you'll see the property taxes, insurance, property management, the maintenance, the utilities, and the management fee. So the management fee is another opportunity for us as the working partners to make a monthly fee that we basically get to take on top of out of the cash flow every single month. So our capital investors are going to take cash flow out each month, and we're going to take the management fee out each month. So when you bring that back up here, our net operating income is about $16,000. Our loan payments are $13,000, and our cash flow ends up being about $319 per unit. And these are our buy and hold projections. So they're really the one that I show my investors is the year 5 analysis. So if we sold this property in year 5, the value that we've created, I'll go back up here. So if we were in year 5, this is year 5 here, the property value is going to be somewhere in the $5.8 million range. Our loan balance would be around $3.2 million. So our total equity is $2.5 million. If we sold the property, we're going to pay about $300,000 in just that. Those are just real estate fees. So our sale proceeds would be about $2.245 million. Our cash flow at the time would be about $193,000. And our total cash invested that the investors put in was $936,000. So when we add all that up, our total profit at that point is about $1.5 million. So our return on investment is down here. That's about 160%. 160% divided by 5 years is 32% annually. And when we divide that by our split with our investors, they're getting about 16% return on an annual basis, and we're getting the same. So these are pretty conservative numbers, but this is what we show our investors as an opportunity to be involved in this transaction. And at the 5-year mark, they can either exit, they can refinance the loan and stay in, or essentially one partner could buy out the other partner and move forward on the transaction. So that's a little bit about the numbers, and that's pretty much all I had prepared. And I wanted to just kind of stop there and see if I could answer any questions.
Okay, can you hear my voice?
Yeah.
Okay, excellent. So I got a question here. Question here is why you buy and hold this one? Are you always doing BRRRR strategy? It doesn't matter the size of the or scope of the building.
Yeah, I predominantly do BRRRR. That's my strength is in construction. So I have a lot of construction experience. So for me to buy something that's turnkey doesn't really make a lot of sense. I have done a couple flips before. I don't mind them. I find I'd rather have those properties long-term. So I'd rather buy them and refinance them and keep them in the portfolio versus just selling them off. But yeah.
Great question of mine. Do you see more ROI in properties closer to Toronto, or it doesn't really matter for you? You can go to Kitchener and Waterloo and create the same ROI on there.
I have a portfolio of properties all over southwestern Ontario. So I have Hamilton, Newmarket, Toronto. I have properties in Alberta, Arizona. And the best performing properties in my portfolio have always been in the GTA, for sure, by far.
Okay, so another question I have here: what was the very first experience with when you got into real estate investment and fix and flip? What was your very first project?
My very first project was a brand new build that I purchased in Alberta, where I grew up. And my thought on it was I was going to buy it from the builder, and then I was going to finish the basement, and then I was going to sell it. So I was hoping to put $15,000 in the basement. I bought it for $130,000, and I was hoping to sell it for $170,000, making about $25,000 in 3 months. And then I couldn't sell it. Not because I didn't do a good renovation or not because the market wasn't doing well. It's just that I bought a new house from a builder, and the builder was still in the neighborhood and had lots available. So I was competing essentially with a builder at the same time with my property, and somebody could go directly to the builder, and for the same price, they got to customize their own floor plans and paints and cabinets and countertops. So I couldn't sell it for what I wanted to. So I was kind of faced with the decision of, do I sell it for a loss or do I just rent it out? And I rented it out and I held it for 4 years. The property doubled in value. And I had good tenants in there, minus my first one who I had to evict. And then I kind of liked the idea of holding properties a little bit longer than trying to turn them over. So that's when I got a little more hooked on the buy and hold strategy versus the quick fix and flip.
Excellent. With this project that you're doing right now, did you have any challenges with the neighbors?
No, so you couldn't see it in the picture, but on one side we have a huge apartment building, like massive, probably 30-story, and the same thing across the street. So there's precedence in the neighborhood for density. And the neighbors beside us are also a rental property. So that's really important when you're going to look at properties, is what's beside you, what's behind you, because those are going to be the neighbors that the Committee of Adjustments is going to listen to the most. And if you've got a neighborhood that's beside you that is a rental property, chances of a rental property giving you any kind of pushback on converting your property to a rental as well is very, very small. So that's really important that we had apartment buildings on both sides. That'll help us mitigate our risk going through the Committee of Adjustments process.
And is there any challenges, generally speaking, like when you drive by the neighborhoods that you see? There would be some challenges with the city if you go to the zoning department.
There's always challenges with the City of Toronto. Forestry is an issue. So you want to make sure that you don't have any massive trees on your property. That can always be a challenge. Parking is a big thing in Toronto. It's becoming less important now that we have things like Uber, and we have more bike lanes and things like that. So the more centrally located you are, the closer to a subway station you are, the more density the City of Toronto wants to create. So you can have less parking the closer you are to a subway station. But, there's definitely something that you have to consider is parking. And that's one thing your neighbors will often get disappointed about too, is if you don't have enough parking, they feel like you're going to build an 8-unit apartment building and there's going to be 16 new cars on the street. So that is something that you have to consider when you're talking to your neighbors is, you'll target people that don't have necessarily vehicles or that they're using Uber or car sharing services like that.
One of the plus of what you're doing is a little bit of market proof, because you're not selling it, you're renting it anyway. So if the market goes up and down, it doesn't really affect you. You are on your agenda and you're doing well.
Yeah. That's why I don't like to play with the market too much. I mean, you're seeing what's happening right now. market value is going crazy because of limited supply and still the same kind of demand. And I think people are moving out of the core. So the condo market's been affected a little bit, in that it's dropping in value, but the single family dwelling neighborhoods are just, people are like, I'm getting out of my condo and I'm moving to a house where I've got a yard in case COVID, kind of keeps going. But I think it's all temporary. I think there's going to be a price adjustment when the government, stops putting money into the system. So, but again, I don't really care so much because I don't generally buy and sell. I buy and I sell, 10 years, 15 years later. And do I think that the long-term prospects of the GTA and of Ontario are going to be good for the next 10 to 15 years? Yeah, I'm a huge believer in the Canadian real estate market and a huge believer in the Ontario market in terms of what the market's going to look like in 10, 15 years from now.
Absolutely. And based on my experience, I 100% agree with what you said. Last question, is it what you're doing right now? Is it your biggest project you've done that before, or you've done something else before?
Yeah, we actually have 2 projects on the go and we're in contract for a third one. So we have one that we acquired that is actually through the Committee of Adjustments process. So we're just getting our building permits now. We're closing on this other one next Friday. And then we have one that's scheduled to close at the end of February. So, when we have this kind of economies of scale, when we're doing 3 projects pretty much back to back, we've hired a construction manager. So I'm going to be project manager overseeing the quality. I've got a designer working with me and she's the one sort of sourcing materials. And then I've got a construction manager that's literally going to bounce around to these 3 sites. But I think when you're looking at the number of units here with 8 units per building, when we're going to talk to a kitchen supplier, for instance, I'm not just looking for 2 kitchens, I'm looking for, 24 kitchens. And the pricing just gets that much better when you're asking for 15,000 square feet of flooring versus 2,000. So we can really find some economies of scale, and our tradespeople, because they can have 3 or 4 jobs in a row, definitely give us preferential pricing there too. So it helps bring our costs down on the construction side.
Excellent. Thank you very much, Darren, for joining us on this webinar. I know you have an obligation and you have to go. Now, would you like to leave some phone number or email address or webpage that our audience, if they need your help, your coaching, they can always get back to you?
Yeah, absolutely. My website is darrenvoros.com. You can check out my YouTube channel as well. And if you need to email me for any reason, you can just shoot me an email at info@darrenvoros.com.
Excellent. Thank you very much, Darren, for joining us in this webinar, and hope to see you again. And all the best and good luck.
Thanks, Ashton. I appreciate you having me on, and thanks so much, and hope you have a great night.
Yeah, take care. Bye-bye.
Thanks.